what's the likelihood that Q4 earnings prints are going to reflect the damage we've seen in the last few weeks?
Yeah, I mean, analysts have downgraded their estimates a little bit, but we're still looking at high single digits. So I think, in fact, I view Q4 earnings season as welcome news for this stock market that's really just down on a lot of, psychology. In fact, bearishness is now as widespread as it's only been since the financial crisis. So to me, with expectations this low, any modicum of good news is going to be taken as great news.
So where does that lead you to on an actionable basis? Burns, let's start with you.
Well, I think that one of the things we've been telling our clients is that the economic data still looks strong. We're still looking at unemployment at the lowest it's been since the 1960s. You're still seeing wages increase. Now, both of these are good for the consumer, which is the biggest driver of the economy. And likewise, we've seen really strong retail sales this quarter. And so, the economic data still looks firm. The New York Fed's recession monitor shows a 16% chance of a recession in the next 12 months. And typically, 10 and 20% drawdowns that are not accompanied by a recession usually bounce back pretty quickly. So we've been telling our clients that focus on long-term allocation targets, but at the same time, with stocks pulling back, having a little bit better entry point, it probably does present an opportunity to maybe to add to a few positions.
Jack, on your central idea that any modicum of good news would help the market at this point, that just simply has not been true. I mean, we started to get trickles out of China last week that the trade talks are actually going quite well and they're reaching higher levels. People thought that would cause the market to rally. We got New York Fed President Williams coming on CNBC saying, hey, we're flexible, we're even willing to rethink the balance sheet policy here. That rally lasted what? Half a day, not even a few hours. So when do you think that the environment changes where good news actually gets interpreted as good news and it's not a fade the rally?
Yeah, I mean, I think it's a disconnect between kind of these headlines, which we're hearing, clearly, I think Treasury Secretary Mnuchin is no Geithner, and I think that was a dumb move on his part. So I think there is somewhat of what I'll call equity market vigilante that's going on to say, look, get your house in order here. But on the other hand, we haven't heard anything from the economy. We haven't heard anything fundamentally from the markets. And when we do, I think we're going to see, hey, this disconnect is really extreme. And we need to get back on track with fundamentals. In terms of valuation, still U.S. equity markets still incrementally overvalued if you take the landscape into consideration, but international developed is fairly priced and emerging markets are cheap. Last time I ran a valuation analysis on emerging, I'm looking at roughly a 10% annualized return for the next 3 years based on where price to sales ratios are sitting today.
Burns, we're so far below the highs in a short period of time that it seems as if we can be arguing about the market versus the fundamentals for a while, maybe till the end of the cycle. I wonder how you think this might play out if the market settles down, if the news flow from Washington maybe quiets a little bit, and we get one of these rallies. Is it going to liberate us from this idea that maybe 2019, maybe 2020, we'll be talking about rising recession risk, Fed cutting rates, things like that?
Well, I do think that the news flow is probably going to stay volatile for quite some time. As long as we have a president with an itchy Twitter finger, then things are going to be volatile. As long as you do have a president talking about threats to central bank independence or trade wars, that's going to be the case. Now, previously, a lot of that volatility had been paved over by easy monetary policy. And now that monetary policy is not tight, but is getting a little bit tighter, you should expect some higher highs and some lower lows. I think one of the things we've been focusing on is looking at dividend-paying stocks to really help cushion a lot of those blows and that volatility going forward.
Jack, big piece today in the Journal about market structure. Quants, algos, machines, passive ETFs, 85%, they argue. They're actually citing Kalanovic over at JPM. 85% of all trading is now related to somehow that model, just dwarfing retail. Do you believe that's why this December has been historic?
Well, I think directionally it has to be real investors with real opinions starting it. However, I do think the algos, because they're all momentum based, are just piling on. So we will see exaggerations. And when you see, 600-700 point moves in a day, I think that a lot of that is just exaggerated algorithmic trading. And so when these, high frequency traders suggest that they're offering liquidity to the market, in fact, the opposite is true. Market makers have to stand there and take the other side of the trade. That's liquidity, and as far as I'm concerned. When you're just piling onto a down market, that's actually removing liquidity from a market, and it is something I think that needs to be addressed.